Hi, this is Jeffrey Cohen, President and founder of Chicago Quantum. I'm here to speak to you. Hi, this is Jeffrey Cohen, President and founder of Chicago Quantum. I'm here to speak to you today, week one of the 2021 stock market, and speak about our portfolios that we've been promoting, that we've been finding with our quantum algorithm, and also just talk about the market in general. It's been a bit of a crazy week, interesting week, and wanted to give you guys some insight on what's going on. And so let's begin. Number one, we had a rather interesting activity in Washington, D.C. I don't know what everyone's politics are, but they were scary. So as I was watching the markets, when the protesters were storming the Capitol, I noticed that liquidity dried up. I noticed that momentum stocks stopped trading. I noticed that a lot of the Chicago Quantum stocks took a pause and their gains started to be lost. And I remember being very scared and very upset. Because we have started to invest not in this last pick that we made for people, but in previous picks of the Chicago Quantum Net Score that we've run on a proprietary basis. And December 18, we made a run, and since then, I want to say, I'm looking at some times here, December 21st we made some buys, 22nd, December 30th, December 31st, and January 4th. So we have very recently jumped into the markets with stocks that have either been newly chosen by the Chicago Quantum Net Score or consistently chosen. It's a fair amount of money. And so, what happened? Let me take a step back. So, at the end of yesterday, actually the market recovered. And so once they realized that it was not that big of a deal. I mean, it was painful, but not that big of a deal. Things went back to normal. The markets went back to normal. And the Chicago Quantum Net Score stocks, there's 7 of them, ended up doing quite well. And so we ended up on the day. We're up since we started investing. It's a pretty exciting time for Chicago Quantum right now in terms of our stocks. And then today's Friday. Today hit. Now, maybe it's easy to make money when the markets go up, but what happened today? So today, maybe a minute after the market opened, all 7 of our stocks were up. It's going to be a great day. It was going to be printing money, right? And then people started noticing the dollar. The dollar value was changing. I heard someone say it looks like it could have been a fear-off day today. Interest rates, I mean, we're up at the 10-year bond. We're up over 1%. Now we're at 1.4%, 10-year yield. So that means the price of the 10-year bond has gone down. Well, what drives the price down? Is it lack of confidence? Who's selling our debt? Is it a foreign government? I mean, who's selling U.S. assets? That's interesting. Gold dropped 4%. Silver dropped 9%. So this is right in the middle of the day. This is in the morning. First off, the Chicago Quantum model has picked a number of gold stocks. And so we have one that we picked that we invested in, and we have one that I personally invested in. And those were not that happy today. So we have a lot of oil stocks. I noticed that oil, the price of front month oil, is up quite a bit. I remember celebrating when it hit 50. I want to say it's like 52 and change right now. That means that the companies that we picked in the oil industry who are highly indebted, highly leveraged, debt to equity ratios of 10, 15, 20, these are highly leveraged. And so if the price of oil goes up and they can start covering their debt payments, maybe paying some of that debt back, those companies are going to be printing money. Stocks are going to go up. It's going to be a great day. So we don't know if the price of oil will keep going up, but normally when the dollar becomes weaker, the price of oil, which is priced in dollars, goes up. So there were a lot of things going on. You got currency issues, you got commodity price changes, you've got foreign currency changes, you got debt, you got all these things happening. And then all of a sudden on Twitter, while I want to say at one point all 7 of our stocks were weak. They didn't all ever drop at the same time, which is nice, which is the whole zig and zag of Chicago Quantum. But there were some tough moments there. And somebody tweeted a tweet that said, "Don't sell your alpha." And it made me think, he's right. If you spend time putting together a portfolio, really crafting a portfolio based on a lot of data analytics and big data analysis, hang on to it. Sell when you're ready, but don't just sell because the market had a rough day. And on the other hand, though, if you're holding what I'd say just passive investments, let's say you're just holding the S&P and you're not confident, you can always get out of some S&P. You can always get back in the next day. It's fine. So I held on. And then actually, by the end of the day, I was trying desperately to buy more of 2 of my favorite positions. And one is an oil company that, like we talked about, highly leveraged. They've been paying down some of their debt. They stopped their dividend in order to pay down debt. They are being very conservative, but they're also investing in actual, properties. They're actually investing capital investments into their oil production, into their services. So I was pretty happy to see that they're making money, and they're only going to make more money as the price of oil goes up. So I was happy. I also tweeted that the rig counts had gone up. Natural gas rigs were up. Oil rigs were up. This is great. Baker Hughes produces a report. And I thought, wow, one of our stocks is actually Forum Energy Technologies, which the model's been picking for months now. And they make money when people bring out more oil rigs because their services are to the rigs. And so more rigs means more money for Forum. And I'm very excited to see that. And so we held on. Now, the reason that I don't think it was really a fire sale today was I actually tried to buy one of the stocks. So I have one stock that's down of the 7. And then I'm going to explain at the end kind of the zigzag thing, how that affected us today. So, but this one stock that I wanted to buy, it's thinly traded. Maybe it trades 100,000 shares a day. So it's not it's listed on an exchange. It's a major stock. It's well over $1 billion. Can't say that. Debt and equity valuation is over $1 billion. It's actually closer to $1.5 billion. But no, they trade about 100,000 shares a day. Under 100 million market cap, but listed on a major exchange. And so here the market, it's down. It was down like 31 cents today. I'm thinking, oh yeah, I'm jumping in. Put in 2 buy orders. One was down like a nickel. One was down 7 cents from the current price. Didn't get an execution. The stock jumped 30 cents from that point. I couldn't get a break. I'm like, I'm not going to chase it. But it's always interesting when you see a stock that's relatively thinly traded and you see it move by a couple of pennies or a couple of dimes. And then you try to buy some yourself and you realize there's no one selling at that price. It must be doing a couple of shares and moving the market, but wasn't trying to buy that many shares, like 100 shares, right? It's a nice round lot. So maybe the market wasn't that weak after all. So at the end of the day, with all these problems in the market, our portfolio made money. Worst day of the year for me, scariest day of the year. People running for the exits, people saying sell, 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 interest rates going up, which is terrible for stocks. The momentum guys that I follow on Twitter, one guy said, look, our portfolios climb an escalator or climb the stairs, but they go down in an elevator. One guy was losing 10, 20, 30, 40% on his positions today. So come on, this is a crazy day, right? We did okay, and the reason is one of our stocks is a healthcare stock. And it's not even like a highly leveraged healthcare stock. It's like a regular healthcare stock. Like, people sign up for the services, and this is the supplies that go into the services. I mean, they're going to keep selling that stuff. It grosses me out, the kind of stuff it is. It's just supplies, medical supplies. Then you have another stock that's a gold stock. Love it. But they don't make the gold. They make the bars. They make the ultrafine powder. They mint things out of gold. So that's kind of cool. So gold going down didn't help much because, less valuable. Maybe people make less gold bars. And then you got your oil E&P, exploration and production. You get your pipelines. You get your services. So we've got a whole tranche there. And at the end of the day, the way our portfolio is structured is we bought stocks that zig and zag at the same time. So when the market was crashing and people were running for the exits and they're saying, don't sell your alpha, we still had 3 or 4 stocks that were up. We had some that were down, but we had some that were up. And so I thought we were going to have a bloodbath. At the end of the day, I looked at my P&L statement. We were up $200. It's not a lot, but it's great. Because what that says to me is, even in a rough market, we've got some protection. Now, not to say we're protected if the market drops. If the overall market drops, we're in trouble. Because we tend, with our Chicago Quantum Net Score, to buy high beta stocks. So these aren't necessarily risky, but they're high beta, which means they move in a leveraged manner. They move with the market, and they moved in a leveraged manner. So if the market goes up 1%, a beta of 1, you expect the stock to go up whatever the change in the risk-free rate versus the market return times that 1. So 1% risk-free rate, the market's, let's say, got a 10% above that. So if the market goes up, we're going to, a 1 means we're going to earn the market. A 2 means we're going to earn the risk-free rate and double the premium. It's interesting. We have stocks with a beta of 3, 3.5, right? So if the markets start to drop, we're going to bleed. But as the markets are going up, we're doing fine. And we have different stocks that move according to different things. Maybe some of the stocks even like when interest rates go up. We're going to find out. And so I just wanted to share with you how we did at the end of the first week. It was a good week. We made money this week. We have a paying customer for our model. This week we had 1, and that 1 customer was very happy. Has been doing very well. And we just started talking to someone from one of the trading houses. So I'm trying to tweet better, things that are more interesting to individual investors. And we just had a team meeting just to disclose. We're still working on quantum walks on graphs. The problem is the rotation maps can be challenging. We did just publish an article. It'll be out on archive on Monday. So check out the new Clark Alexander published a new article. And we're working on skewness and kurtosis. So thank you very much. If you like what you hear and you want to learn more about the Chicago Quantum Net Score, please, in the details, it shows you it's www.chicagoquantum.com. You can get in for as little as $50. One time, it's not a monthly. You can send us up to 64 tickers, 10 backups. We'll run it for you. We'll do a full analysis. We'll send you a report. It's worth a heck of a lot more than $50. Takes me a lot of time to run it, but I want to get people in. And then for $150, we also run it on a quantum computer. The difference to $100 actually goes towards the cost of the quantum computer. And if you want to run the big job, so all dividend stocks, all exchanges in the U.S., got you covered. So that's a cost a little bit more, though. So thanks again. Appreciate your time. We're going to try to do this every week. You take care now. Stay safe. Bye-bye.